Happy Friday, everybody. Welcome to the 22nd edition of Real Assets Weekly. With me is my compatriot, Jimmy Wang, up in Portland. Jimmy, what's up with you, my man? Happy
What's
Friday.
going on, Turtle? Happy Friday. This is the great ice apocalypse of 2024. I told you, we were off air earlier, but I had a Airbnb trip to this kind of snowy cabin, going to do some winter sports last weekend. Got canceled out. So I had to, fortunately had some insurance for that. I was in the hole a good amount. And the insurance is just making me go through the claims process, man. It's like, what is the name of the winter storm? And it shows documentation of the exact roads that were closed. That they're just fighting tooth and nail to not pay out these fucking claims, dude.
Crazy.
It's that's capitalism. They're looking out for their shareholders. I'm looking out for mine. So
That's right. That's right. That's right.
but here we are. We're talking real assets. We're talking all things today. Happy
Yeah.
24, everyone.
Happy 24. Welcome to the 24th year post 2020 and or post 2000. And I think it's going to be an interesting one. And already in the real asset space, Jimmy's a former buy-sider on the REIT side, so I think we got to start with REITs. A couple big tennis balls here in this last week. We had big dividend cut from our friends at OPI, Office Properties Income Trust. Anyone who's been loosely following the financial markets, office dividend cut really shouldn't be that much of a stretch, but we'll kind of get Jimmy's take and maybe some read-throughs or like things we can learn from the dividend cut. And then the other big REIT news was this morning. Tricon is Tricon, right? TCN. Yeah, Tricon bought out by our friends at B-REIT, right? So Blackstone has their private REIT, and they bought out
Congratulations to all the bankers, associates,
congrats,
analysts, who got their acquisition bonus and targets this year.
Well, I mean, congrats to the TCN shareholders getting taken out at book value. I mean, that would be nice, right? As a REIT shareholder, I'm looking at my shares trading at like 70% of REIT NAV, and I'm like, hey, I mean, if we get taken out at NAV on these apartments,
that's the dream. That's the upside scenario at this part of the cycle, right?
Yeah. And then, we can get into some of we'll talk, maybe if we got time, we'll get into the MSOS stuff or some of the happenings in cannabis stocks. Could be a real asset if the federal government allows it to be. And even, the fakest asset of them all, cryptocurrency. We'll have to talk a little
Oh,
bit.
yeah.
Let's
go.
On the ETF.
I initiated a short position in Ethereum. Did nail the top, it looks like, over the last couple of days, but we'll see where that goes.
It's funny. I want to get your 2 cents on that. I believe it was Real Assets Weekly number 15 from October, episode title Yields Mooning, if you want to look it up on our database. You said something I'm paraphrasing here. You said something along the lines of, everyone's talking about shorting Bitcoin. I'm excited to short Ethereum. Something like people say, I think is what you said, people say 95% of projects priced in Ethereum are worthless. You said, I think it's higher.
Yeah, I mean, if you look at the actual databases and you look at I'm not the crypto expert, but when you talk about different layers, if Ethereum is a big technology, there's like a blockchain component to it. There's a lot of developments that are built on the Ethereum. There's layer ones, layer twos, but if you think about just the nature of the shitcoin pump and dump, you're creating something, you're using Ethereum as a base unit, and there's like a pump and dump element to it. But over the last, it's been several years now, but I think finally there's the idea that there's these frictional transaction costs in Ethereum called gas or GUI, that are often a ridiculous percentage of the actual transaction volume or the price, is turned a lot of people off. People have increasingly gone to Solana because it's cheaper to transact. So if you're using it as a currency, if you're using it to try to build an economy, imagine you have a Web3 video game And the more time you spend in the game, the more credits you earn, the more currency you earn in the game. You're trying to monetize that into something real. You don't want to get hit with a 20-30% transaction fee every time you do it. You know, there's less friction in some of these other currencies. But again, it's these digital baskets are all kind of in that same boat. And, you know, everyone's been talking about the Bitcoin ETFs that have come through. You know, maybe that was a bit of a local top. People are talking about the halvening that comes later, another kind of talking point. But when we talk about correlations and what doesn't look like the other, I mean, really since the fourth quarter, a lot of risk assets have gone on that run. But with the markets now racing basically at all-time highs, dude, S&P, you see that, right? More or less. Different index constituents, you know, NVIDIA continues to just go. But you know, Bitcoin kind of stalling out now in the low 40s where it peaked at 69-ish. It kind of shows you just what hasn't necessarily caught up. And I'm not saying Bitcoin has to go back to the all-time highs. But when we think about the kind of the ride of various risk assets, whether it's QQQ, kind of really look at that, right? You know, which of these is not like the others? So I think there's still a lot of trap bulls in the digital currency space.
That's really interesting. I think we got to go to one chart that is interesting is like, got to go to BITO, right? So the original Bitcoin ETF, back in the late 2021 period, which seems like a long time ago. That was basically BITO was the high of the BITO launch was in November 21, and that was very close to the high of QQQ, SPY, you know, pretty much whatever you want to look at, Tesla. So I guess so it begs the question. Yeah, to your point, you know, it's kind of, there's a history of like even MSOS, right? Didn't MSOS basically launch at a high for weed stocks? Well, not quite, but it wasn't. It launched in September, and then the high was in following February. So you had about 4 months to get your money in before you had to start getting it out. So I guess the question is, you know, probability favors this being a local high, and or that's just kind of, you know, I guess we're just kind of anchoring on a couple of data points there. I don't know. So what do you think about that? About it being the ETF marking the high?
I think it's, again, everything is clear in hindsight. It would not surprise me if the talk about the institutional adoption, the inflows, and everything kind of marked that local euphoric high from a sentiment standpoint. Our friends at Hedgeye have recently sold crypto, and they were long that asset class. So again, price volume volatility. You know, again, they were seeing things where it was not catching up with others, and it lost some price momentum, kind of stalled out in that mid 40s range. And, you know, let's see if it flushes back into the 30s or the 30s. But, you know, the maxis are going to maxi, right? That's all I got. I can't compete with that.
That's right. That's right. The maxis are going to maxi. The maxis are in full strength. I had somebody, had a homeless person walking to my office yesterday and tell me about the proselytize to me about Bitcoin. That was interesting. Let's go to quickly before we move off of it. You mentioned another quantitative research service getting out of the asset that shall not be named. And Hilbert here at Swami Research, you know, we have noticed this is today's daily ETF report. You can get it. Go to swamiresearch.com and click daily ETF report and put your email in, and you'll get this every day for free in your email inbox. And if you go, we have a whole page dedicated to cryptocurrency. And as you can see, a couple things here. One is that the 1 month price momentum, well, you can see the columns of green turning to columns of red, right? So meaning like, you know, what was positive price momentum on the 3 month look back is turning into negative price momentum on the shorter look backs. You see the Swami scores are kind of oscillating around 0, but on the 1 week delta or the change over 1 week, it's kind of changing for the worse. So, the Swami signal, the Ouija board, it's smelling that maybe it's the price action is a little bit stinky. That's kind of
Yeah. Yeah, and we don't even have the miners here yet, but the
right.
miners, they pumped and they're down 50%. And the machine, when it looks at stuff like this, especially when you lose the 1 month price momentum and you're looking at the 3 month,
Yeah.
because of how quickly the run up was, I mean, the anchoring on the 3 month, we're still 30% above for a lot of these names, right? So it's like if the market, if S&P pulls back, we've seen weakness in small caps and the Russell too. But if we have a bit of a risk off session here, the floor is a lot lower in the near term.
That's the other that's the last ETF marking the top that was also in the back of my brain rattling around was BITI, right? So BITI
Bag holder
got the high, BITO is the long futures ETF for the uninitiated. That marked the high. Then soon after that, or a year after that, the BITI is the inverse ETF. So you can be long BITI and you're betting on Bitcoin going down. That marked the low, so it's a hard game if you haven't figured that out. And that's why talking to a dude like Jimmy, who's battle hardened.
I didn't hear no better. I'm still here, man.
Dude, yeah. And that's the thing is it's a hostile market for longs, for shorts, for anybody getting complacent. All of your sacred investment cows will be slaughtered by the end of the cycle, I'm convinced.
On the as I get older and I hear about the veterans who are still around, I think there is that appreciation. When you win and you lose and you look and see who's standing, you kind of, we always say unity through suffering, but there's kind of this realization that like people who have been around for multiple cycles, who've survived, who've had to do different things, whose businesses have evolved, when you live to tell the tale, and like there's everyone has skeletons, everyone has all kinds of stuff, right? And I think if 21 and 22 you had this movement of gurus and YouTube gurus and all these other trade with me types, I think as we come out of 23 into 24 and some of that newfound retail trading kind of goes away, I hope we're going to get back to this. Hey, let's keep it real. 2024 is going to be a doozy, and it's a year we all got to keep it real.
Yeah. No, I think that that makes a lot of sense. One by one, more and more people I talk to, and they'll realize how long it's been just since the world changed and has not. And maybe it's time to go back. I don't know. But,
hey, and since we're on the topic of keeping it real, I want you to pull up Lucid. LCID and just a little where things were and where we're back to.
You are here
doesn't
now.
Doesn't it feel like yesterday when the Saudis got in and this was like $100 billion company, they had the new car and it's like untouchable, right? Where are they now?
Yeah,
it was hard to short that sucker. People are getting burned. Where are they now?
Yeah, the EV thing is popping pretty hard. The Tesla price action, Tesla Swami score, whatever lens you want to look at it.
Not like the others, right?
Not like the others anymore. Exactly. It's would be concerning if I was long the stock.
Yeah, for sure.
Let's look that up.
Anyway, I digress.
No, you're good. Yeah. So let's get to look at that. Here's the Tesla Swami score is negative 67. And we'll give you we got trend at 228, 229. So until it gets back above that, you're fighting an uphill battle. So let's go to the weed stuff before we get into the REITs, and then we can wrap on the REITs. But so talk to me. You've got some legacy bags you're nursing. I guess to clear the air with our subscribers, we should probably come clean about where we're at on this. I'm personally still carrying some bags from Q1 2021. I thought cannabis for investments were interesting then. My biggest one was at $10 per share. It's now at about Well, it's up off the lows of about 10 cents per share, and I think today
It doubled, right?
we're at I think we tripled, Jimmy. We're at the
You
33
tripled.
cents.
Let's go.
Yeah, only a 97% drawdown from my original cost basis, which is
Yeah.
better than 99. And so that's where I'm at. But that's just one investment. I haven't really held any other cannabis investments in size other than Graham. I thought that Graham
Mm.
with Jay-Z and the complete disaster that was. Um, but yeah, where are you at? What are you holding, and what's exciting for you?
Today, there's three names in my portfolio. I've got Green Thumb, I've got Verano, I've got AYR. So Green Thumb is the largest of the companies, really, right up there with Curaleaf, north
Yeah.
of $3 billion in market cap, or right around then. They have one of the largest footprints. They are, considered one of the higher quality, just larger players. So by factor exposure, this has larger cap exposure, better profit potential, better balance sheet. Verano, also a large company, does over $1 billion in revenues.
Oh, sorry.
And then AYR, a much higher levered company that unfortunately they IPO'd right at the peak. I
Right.
think they have a pretty good footprint as well. Yeah, I've really exited my bags. I've got 30 years of tax loss carry forwards now that I'll never be able to to realize. We'll see. We'll see, right? We got some capital gains offsets for the future.
Right.
But the cannabis space has evolved. We were talking right before we started recording that a lot of the guys that got in right in that late 2020-21 period, you would think about the trifecta, right? The Democrats take the presidency, they have the House and the Senate. We have massive COVID stimulus. So people are staying home. They're getting money for alcohol, for booze. Weed is labeled essential, so stores stay open. And there's an influx of discretionary income, particularly at the lower and middle half of the country. So really a perfect storm. This was a good time for if anyone's going to pass, the Democrats are going to pass. And that was the party line, so to speak. Fast forward 3 years later, 4 years later, frankly, there's been a proliferation of illegal businesses. There's been zero enforcement of such openings. So as an industry, we've seen a lot of price compression, like a lot of commodities. This has been a boon for the consumer, but for the business, it's been a lot more challenging. You have legal businesses that continue to have idiosyncratic handcuffs. If you're a legal business, you're paying a lot of taxes. You're paying 280 taxes. You can't get banking. There's a lot of ways that a lot of the operators are having to play in an unfair game, so to speak. So the fundamentals have declined, frankly, right? The internal growth has slowed from the stimulus going away. The external growth is limited. A lot of states, operators have pulled out because they're no longer profitable, even though they're a great state. I mean, look at the great state of California, right? It's synonymous with marijuana consumption, but probably the worst state to operate in. All the single state operators are going belly up. Incredibly difficult operating environment for legal businesses. So on the cusp of this 2024 election, we see that the Human Health and Services Department has basically issued a letter to say, hey, we should reschedule marijuana from Schedule 1 to Schedule 3. This has been a huge contentious issue, that marijuana was labeled as dangerous as, heroin, fentanyl, or maybe even above, all these different classifications, antiquated classifications. It precludes the ability to do medical research for scientists because of its designation. There's a lot of these hefty taxes. There's inconsistency in enforcing laws between states and the federal government. So if we move to a Schedule 3, some of the excise taxes go away. Perhaps we definitely get access to some kind of banking platform for these growing businesses, and undoubtedly a positive. Maybe you even see custody, banks getting back in, allowing marijuana companies to be owned by investors, to be held by custodians. So there's a lot of positive catalysts, but we're still in this uncertain environment. If the Republicans take that, the presidency in 24, what happens to the bills then? And
Right.
these are really bipartisan issues, to be frank,
It should be.
but they continue to be um, used as bargaining chips. And so we are in this kind of impasse where the institutions are not quite in there yet, but you're seeing some speculative activity come back to the forefront. The sector is still very volatile. You still have a lot of trap bulls. I think a lot of the shorts are down. If you shorted marijuana in 2023, you really got burned at the end of the year. So there's a little bit more like, hey, maybe the juice has been squoze from the sector on the
Right.
short side. But
Right.
as far as the price volume volatility characteristics, certainly not for the faint of heart. So we're still very much in, as the long-term weed guys say, they're right. This is the sector. This is what they're comfortable with. They're comfortable with I don't know if anyone's comfortable with the drawdowns, but there's always a chance to get in lower, as they say.
Yeah. Yeah, yeah, that's been the case for sure. Yeah, it's been such a mess of an industry. These signals are always changing, right? And that's why we publish
Yep.
this every day for free. But the Swami score now on MSOS is good, so that's interesting. If we hold above that trend line at $7.15, then maybe you have like a backboard to lay it up off of.
Yeah.
Um,
And
but
I think the trade line is a little higher. If you look
oh,
at
for sure,
this,
yeah, I would imagine.
the most recent, it's probably closer to $8 now, north of 7.50.
Yeah, sure. I think that's about right. And I think that to your point, it's it's a mess, right? To your point, and you brought up a lot of good points there. And it's like, look, if you don't have return, these guys don't really have. It's kind of like it's not that different than investing in like Chinese VIEs, right? It's like, what is the legal basis for you getting your money back? It's not super strong, right? It's
Yeah.
you're funding a Schedule One narcotic that trades with 5 ticker symbols on an OTC like listing. It's just a mess. There's some good coverage on FinTwit actually. I thought that this guy Toby Chanabis, he's good. I follow him. I think he's part of Poseidon, and it's like a well, I believe he's a Poseidon guy. These are like VC guys that have some cannabis exposure, and they do some good coverage. And they had a guy, Brady Cobb, on there, and he was doing a Twitter space the other day, and he said so the big piece was there's been a lot of these Freedom of Information Act that declassify these government documents, and there was an HHS. I'm getting into deeper water than I need to go, but my point is just that like there's an HHS document that was declassified, and Brady Cobb said it felt like reading a confession. I think the story is his dad went to jail for illegal cannabis, and then he became a lawyer and kind of dedicated his life to like fighting, for cannabis reform and stuff. And it's like, basically they said in the document that cannabis, these are things that shouldn't be too shocking, but cannabis is healthier than alcohol. Alcohol is not scheduled, right? So it's not Schedule 1, Schedule 3. Alcohol is not a scheduled substance. So the point is that I hope you're right. I hope there's some real momentum here, but like you said, we've just been as cannabis investors been fooled and disheartened multiple times before, and it's a weird thing, man. And
Yeah.
yeah. So, and the last thing is, as we discussed, I believe last time, it's like they also did it in the wrong order, right? Where it's like, at least with Bitcoin, it's like they're letting you. They do this thing, right, where the regulators have done this before, where it's like they'll let Coinbase list, but then they're not sure if it's a legal business or not. They'll let you put your money in, but then they could just rug you, right? So I
Yeah.
guess the point is that yeah, I'll be very hesitant to put more money into the sector. That's my point. Let's wrap on a couple of REIT ideas, or two REIT topics.
Yeah.
Maybe let's start with just quickly on the TCN, Tricon, I believe it's Tricon. Tricon
Right.
residential, 38,000 units,
If you
mostly.
look at the Toronto stock exchange ticker, you have a longer
Gotcha. I hear.
back period, and I can tell you a little bit about the story, as they
I
say.
would love to hear it. Tell me a
Yeah.
story, Jimmy.
So,
What's going on here?
um, first, I think the deal came out this morning. I think it's a win-win. So I think it's good for both parties. Blackstone gets to deploy capital. As we've discussed countless times, when you have a private entity that's not necessarily mark to market and they are raising capital at 100 cents on the dollar, this is a very accretive, quality accretive, probably numbers accretive to their platform. It gives them a reason to exist, a story to tell their shareholders. The machine keeps chugging. People keep their jobs. It's a whole, as an industry, this keeps the party going. And Blackstone certainly has the capital for that. Tricon has about $1 billion of, development, pipeline that needs to be funded. So you think about an environment like this where cap rates have exploded higher, whether someone recognizes or not, right? Just by virtue of prices and transaction volumes, the implied cap rate has definitely gotten higher. They were again, a little backstory into Tricon. Even though Tricon is listed on the TSX exchange, Tricon is effectively a US based Sunbelt multifamily developer by trade. And when we look at the stock really since the last decade and a half, since 2010, 2011, coming out of the GFC, there's a couple of divergences that, when I started in REITs, I noticed. First, the REITs in Canada are a lot more retail owned, right? We mentioned this before. So there's looser governance, there's less focus on total return, there is higher leverage because of the yield component. So these companies structurally utilize more lower interest rate leverage. You think about the interest rate regime in Canada versus the US, they were both in very low territory, but Canada even lower. So, for a country that's small, that doesn't have the secular growth aspects that the US does, here you have a small Canadian listed company using cheap leverage and a popular shareholder base to then develop US assets in the Sun Belt. Immensely accretive, very popular story. It's a way to get US exposure without being in US, or said differently, it's a way to get non-Canadian real estate exposure in a real estate index benchmark playground. So you can imagine why I'd rather be in the US than be in Canada, up in Nova Scotia, Prince Edward Island, in one of the two, at the time, CapREIT and Boardwalk were the only two Canadian apartment guys around, but very much, got burned in the GFC with too much leverage. You have, rental controls in these biggest provinces that limit their internal growth profile. It's a whole story. But here you have this small company that's total return focused, that adds value through development and has the leverage profile that you want if you're a bit of a degen, right? You want that juice. So this company's done very well for many, many reasons. They've developed, I think, to my knowledge, pretty good quality product. And you can imagine the founders have quite the low basis. So this is a way that if you're in Tricon and you've been in there for the last decade, you get out and you don't have to take the mark, right? Because now you get OP units. You're in the private structure. You're probably deferring your capital gains taxes, right? If you're in OP, imagine if you were in OP that came into Tricon, right? They're a developer, so you were a landowner. They took your land and you didn't want to sell out of your low land basis, and you gave it to the developer. You took OP units in Tricon. Now you're funneling. Now the game, basically, again, the game continues. So everyone who's made money, now you're in BlackRock. Your capital gains are still deferred, and you're part of this stable structure, so to speak. If you're BlackRock, right, you have a reason to utilize your capital. You have a story to tell, and again, just looking at where the stock was at the end of 2023, in that kind of third quarter low, this was this is a 1 month, but if you look intraday, it got to like maybe $6 or $7 TCN in the US. Right before kind of selling out here at about 11 or so ish.
Yeah.
So just in the last 2-3 months, shareholders that stuck with it, at least have had their fundamental thesis realized, right? That there was some value that the public market, as a discounting mechanism was selling off. Again, the game continues, so to speak. But who's next?
No, great stuff. Look at that. That's man, that's years of REIT knowledge compacted into 60 seconds there. Really good stuff. I guess maybe you could say the bull case, bear case, or tell me what you think about this assessment. Bull case, bear case. Bull case is, like you said, they're picking up 38,000 single family rentals, at a decent price, I guess. The bear case, or not, that is the bull case. They're picking up 30,000 rentals at a decent price. The bear case would be, this is Blackstone trying to paper over maybe NAV gaps or something. But what do you think about that? You said it was mutual. You see it as mutually beneficial, but
I think as a byproduct of acquiring this platform and saying, hey, now we have a need for $1 billion, right? So whatever cash flow it spits out, as a public company, if you are sufficiently trading below NAV, the question becomes, why not just buy back your stock? If you can't develop accretively, if you can't acquire accretively, if you can't do anything with your capital, and you are a REIT structure and you can't have retained earnings, why not buy back your shares, right? If your shares are trading at a very low multiple or a very high implied cap rate, that would be the best capital allocation decision to go about if you're a management team.
Right.
But if you're a private entity and you don't get marked and you're still, at your NAV or at whatever, there's inflows and outflows, right? So this doesn't address secular outflows, but this is a way where, well, one, instead of buying properties, the tricky thing now, right? The real estate works in both ways. You can't buy something for 40% off. If you do that too many times, the market's going to realize 40% off as the price. You can't say you got a good deal if you buy these things at structural discounts that are no longer structural discounts. So like Blackstone is not in the game of buying, if their mark is still a 5.5% cap rate, you can't go out and buy units or buy companies trading at 7.5, saying, oh, we got the steal of the century. Look how accretive this is. Like if you start buying enough 7 cap rate assets that look exactly like your portfolio, someone's going to wise up and say, hey, maybe your portfolio is a 7.5, right? So in a public vehicle, that's where the correction comes in. In a private vehicle, again, these are book value accretive to where their book value is trading, certainly. And it's not a cynical take, but from an industry standpoint, it keeps things together, right? It keeps jobs together, it keeps expertise together, it keeps management teams, operating teams together. So you could say there's some type of longer term synergy in keeping these platforms coherent. We already know that Blackstone has a ton of single family rental product. So folding Tricon into their mix is probably, talent accretive.
Real great stuff. Last question, real quick on this is regulatory. The TCN, you said it trades on TSX or I guess TSE, whatever, but it's it's Toronto listed. It's a Canadian company. Do you think regulatory wise, like I gotta imagine it's Blackstone, right? Not BlackRock. Blackstone buying anything, but especially a bunch of 38,000 single family rentals. I'm sure there's some populists in that would, or I'm sure there's people that would scoff at that.
I think if Tricon had more of a Canadian exposure, that it could present some headlines, in the US here, even though Blackstone, again, as a percentage of the whole market, they're not meaningful because of the fragmentation in the single family rentals. But from a news flow, when they are the incremental buyer and they're bidding up all these homes, there's a lot of populist backlash. So, if in Canada, where you have notorious rent controls, low supply, and you have these perpetual housing shortages, if they had a 38,000 unit portfolio in Canada, in Ontario, in Calgary, in these big population centers, then I think you would definitely hear something. But for all intents and purposes, this is a US company with a Canadian listing. So there was that kind of stock market exchange arbitrage, if you will. But from a platform standpoint, I don't think there's going to be as much pushback.
Yeah, makes sense. Last topic of conversation here before we get you back to your Friday. OPI, Office Properties Trust, or excuse me, Office Properties Income Trust is an office REIT. It's big. We don't have a Swami score on it, so we didn't think it was that cool or that important. But OPI down big on the news. Let's take a look. The stock moved up. Let's look at it daily so we can find that cut.
For a second, I thought you were talking about MPW. I mean, look at the chart.
Yeah, basically, right?
Son of a bitch.
So, but I just thought it'd be a cool kind of like thought experiment just to look through a dividend cut in a REIT. Obviously, REITs are, income vehicles, right? By tax code, they have to pay out the vast majority of their earnings to shareholders. So, yeah, I guess, now OPI, I was going to pull up Koyfin and go through the historical dividend, but we don't have time. We'll save it. But basically, the gist is that this isn't their first dividend cut. They've cut dividends several times before, and their dividend has kind of been a melting ice cube since 08. So there's not, shouldn't be anything too shocking to market participants. Again, a office property trust cutting dividends, and then one that's cut dividends historically before. But yeah, any thoughts or just on the cut itself?
Yeah. I think first it's important. Let's try to overlay OPI with, let's say, BXP. Let's just put another office company in there, just for a little perspective too.
OPI. I'll give you a weekly. Come on.
Yeah, let's do the weekly versus like with a BXP.
Yeah.
See if we can
OPI,
overlay
and then here let's add let's do that. Add BXP. BXP's Boston Properties.
Boston Properties.
Kind of like a
different portfolio, but larger
best in breed kind of office.
Yeah.
Right.
Yeah. So again, over the same time period when the largest office REIT is down 50%, or what have you over the interval. And I think the 2018 timeframe, it tells a more of a fundamental story. But the story with OPI, I mean, I think one, if people know the dividend is not sustainable, then it doesn't hold the same weight, other than the odd retail article. Look at how high the yield is, right? That doesn't have a lot of due diligence. The investor today is not necessarily buying dividends for their level, but for the sustainability. And we've all known that, REIT dividends in this cycle of higher interest rates, higher interest expense, lower levered cash flow yields, lower occupancies, lower net rents, higher tenant inducements, all that stuff, right? The trend was clearly in the other direction. Unique to office properties income, if you think about their story a couple of years ago, they really they were also trying to get away from suburban office because suburban office was an albatross. And with their historic presence in the DC, Baltimore area, their work with the defense contractors and their government relations, they had pivoted toward a data center / office type of hybrid portfolio where they had a lot of data center exposure, presumably with, mission critical defense contractors. And that garnered a higher quality multiple, as they argued. But I think just this last month, we've seen more headlines that a lot of government agencies are ditching their leases ahead of schedule, years ahead. And so the whole shtick with a company like Office Properties was like, hey, if you're investing in Brandywine, which is a suburban office landlord that has properties in Philly, Austin, some kind of secondary B markets, those corporate tenant employees, I mean, they're not coming back, right? The fundamentals there are not great. But if you have a captive landlord, and we've talked about DEA too, you know, same thing. They only do government agency offices in the middle of nowhere, but rather than getting and let's take a look at DEA. I'm kind of curious how they're doing, right? It's same story. You know, whatever premium, and you look at really from 2022, 23, because 2022 was a bad year for everyone. In the recovery that we had in 2023, the stock was still down. Turtle, why don't you go starting like maybe even the 1 year look back for these two companies?
Yeah. So zoom in a bit.
Yeah.
Let's go like this.
We can do the 1 year, right?
Yeah.
You know, again, surprising, DEA's kind of held the line here, but again, the story and the attractiveness of the asset class has waned. And you know, I think we find ourselves in this kind of 2024 moment where the demand for REITs is less than the supply of REITs. The demand for office REITs is less than the supply of office REITs. And you know, these are just companies that the portfolio manager in me tells me, you know, these are names that you own 1 or 2 years out of the cycle, if you get what I'm saying, right?
Yeah.
There's certain factor exposures where you want to be long this basket, but now's not the time. And when you don't have a need for these small, you know, kind of names here and there that don't do much, and the REIT dedicated portfolio manager has a pool of capital that he or she has to deploy, these names just lose ownership, right? But certainly from $3, could it rally to 5? Could it get to 6? Yeah. Right. And there'll be a time where high beta factor exposures, leverage, office factor exposures, when you see that 1 month price action, you know, when Swami picks it up, we'll talk about it, you know. And like I said, you could have a 2-bagger off of a low that doesn't really change the fundamental story. But directionally, I think we see where it's been trending.
Totally. No, and you bring up so many good points, but it's like you said, from a portfolio management standpoint, it seems like you're taking a lot of kind of credibility risk, really stepping in here and buying office versus
you don't get paid, right? When this name
right.
is 10 basis points of the index, you don't get paid to lose your job.
Right.
Putting
Versus,
20 basis points into it.
Right. No,
if
right.
you're bullish and you don't want to get burned, you've got 10 bips of your portfolio, right? So you're evened out with the index.
Right. Versus on the other side, on apartments, you have the drawdown, but then you also have this, you know, this secular housing shortage kind of thesis that we've kind of all settled on, that, you know,
but with the bigger caps, you also have more S&P interest. You've got, you know, different buyers on the margin, right, that are bidding up these baskets or selling the baskets. But
no, that totally makes sense. Really good stuff, Jimmy. Always appreciate the opportunity to pick your brain and chat with you. We'll do this again soon. Thanks for tuning in to Real Assets Weekly. We will do another one on REITs with Jimmy here soon. So tell us, dear listener, reader, what do you want to see Jimmy talk about within real estate, real assets? That guy's a CFA, former buy-sider. He knows a lot of stuff. And one topic I'll throw out there is like these here this will be a fun topic we'll dig on soon, is dividend bros, like these guys on Twitter and stuff that are like, I live off, look at me, I'm traveling to Mexico on dividends. That would be a fun like case study of like, here's a buy side REIT analyst telling you why like you should really be careful forcing your total returns to come from dividends, but also maybe, you know, a little bit of also.
I love those accounts, man. I love the ones where the dude's got like $100 and he collected like $1 of dividend, and he's like, "Yo, I'm stacking. I'm stacking."
Well, shoot. At least he's not short a bunch of crap that's up 100%. So
I know.
but
someone's making money.
Dude, I know it is. I guess I'll close on. You know, I think it is very. I get it. It's philosophically very appealing, like dividend growth, and I think I think you can find some evidence to both, right? I do think that they're all working. So we'll discuss it on another topic.
Hey, I want to leave us on. Please. Just show the audience the NVIDIA chart right now.
Sorry, what chart?
NVIDIA.
NVDA,
This is
it's up
out of
another
control.
3.5%
I mean,
today.
we're
Oh my
fully in the
goodness.
euphoric stage of the cycle.
Yeah.
Really since last June, you know, that this Taiwan Semiconductors reported they had some good earnings. But let's just zoom out 5 years.
Yeah.
1 year, 5 years, but 5 years is most illustrative. If you think you're not going to get a better entry point, you will. Let's just leave it at that. This has kind of been the year to date, right? Can you zoom out a little bit?
No, this is yeah, this is further than that, but yeah, this is like a weekly here. I mean, look how it retraced to its
The
we're not
quick retracing and then the kind of blow off top we've had over the
right.
last couple months, like that last little leg higher. Um, you know, again, not financial advice, right? But don't think it's never going to come back down.
Not financial advice, but you could have got it at $100 in October of 22, and it's
Yeah,
$588 today.
yeah.
It's a
And
different
you know, some things have changed, but
some
I
things
don't
have
know that a
changed.
lot that's changed, right? Yeah.
Not every
That
yeah,
that's
exactly.
that's a doozy, dude.
That's a doozy. We'll get you one of those guys. You keep tuning in to Real Assets Weekly. We'll get you one of these.
Yeah.
Keep stick with us. Stick with us.
Let's
Uh,
go.
let's go. All right. We'll do this again soon. Jimmy, appreciate you. Real Assets Weekly
Always
point of
turtle.
view. Have a great day, my man.
Take care.